All right, I'm going to call this Board of Finance meeting to order. First thing on the agenda is approval of the minutes from January 22nd, 2024.
I'll make a motion, we approve the minutes as submitted.
Second.
Any discussion? All those in favor?
Aye.
Aye.
Motion carried. The next item on the agenda is the extension agreement for our banking services with First Merchants.
Seems like we just did this.
We did, but I think officially it has to be.
Yeah, I didn't dig that deep into the statute, but for the last several years, the Board of Finance and the commissioners have signed off on it, and so that seemed like the appropriate thing to do.
Okay, I'll make a motion, we approve the one-year extension with First Merchants.
Second.
Any discussion? All in favor?
Aye.
Motion carried. The next item on our agenda is our market update by Jessica Redmond.
Hello. Thanks for having me. As always, thank you for the business. Happy to be here and just kind of give a mid-year, I guess, late-year update, which is really good timing because a lot of things finally look like they're starting to change from the environment that we've had. So the first slide, you guys have seen this time and time again. This is our historical Fed funds rate. I like to start with this because, like Yadira just, worked on the banking relationship, that's all based on overnight rates, and Fed funds is your overnight rate benchmark. I think you get, 10 basis points over, which is phenomenal. So that looks like in no way, shape, or form is anyone expecting that to last, which is probably why they're only wanting to renew that for a shorter time frame this time, to give themselves some flexibility. I don't know if you can tell in the print, but there's a little gray area as well in this slide, and that's kind of the range of where the estimates have been over the past year, but basically they've all been lower. Blue is what the Fed itself is projecting in terms of year-end rate. So looks like a quarter point, they're saying probably this year. And then four quarter point cuts or a full percentage cut the following 2 years roughly, to get us down to more of a 3% rate here in a couple of years. So that's a big change, but I would just say keep in mind that it's not zero, which is where we lived for so long. The next page, it kind of reminds us of where we've been. So that bottom line is showing you the rates for each time frame, and that was back in August of 2020. So we remember that when Fed funds was at basically zero, and then all the way out to 3 years was pretty much zero. And then since the county can invest out to 5 years, you got a whopping 0.25%, So that was really rough lean times. I know Yadira just mentioned $8 million in interest income this was that year to date this year or last year? Last year. So big change from where we were just a couple of years ago. And obviously the projections, both from the market and the Fed, are not to go back to that, but get back to something a little more normal. Another thing to look at in this, rates across the board had peaked in the fall of 23. So you see that top blue line where it was sort of a flat 5% almost anywhere from 0 to 30 years. That was great. It didn't last very long. And the most recent one is the darker blue. So longest rates are 4%, close to 4% way out to 30 years. But again, the county can only go out to 5. So we're still looking in that first, chunk of the diagram, and we definitely come down pretty fast from the overnight rate to the 5-year rate, but again, it's still above 4%. So that's probably still a really sweet spot to be investing, and that's what we continue to do with the portfolio, is just to keep rolling maturities out to that 5-year point. Looking at, what do we think is going to happen overall, and what's to be expected with the economy and interest rates in the markets. Inflation's been a big part of why the Fed has kept rates high, and because things have started to shake up a little bit lately in the economy, that's why we think it's much more likely that they're going to start pulling them back. One of those has been their core mandate to keep inflation around 2%. We're approaching back to that level, definitely back just below kind of the long-term average, and quickly coming back closer to that 2%, but we're still north of 3%. So we're getting there, but we're not quite there all the way. What's been keeping it up? I love this next chart. I think when we talked, maybe it was 2 Januaries ago, we were talking about used car prices and how crazy those were. So this is breaking down inflation by what the biggest contributors are. And you can see from 21 to 23, energy was a huge impact. That is not the case now. You see it's actually a drag on the inflation. Core goods, and that was, I think, supply chain driven. Everything that had a supply chain, it was messed up, and so prices were sky high. Dining and recreation, all of that was a labor shortage from the pandemic runoff. And then shelter started to build. And now what you see is that dark blue shelter is the biggest component of inflation still, even though it is becoming, it's declining, it's still the largest part, and it's still a big problem. So we know all about that in this county. But if you think about what happens when the Fed lowers rates and interest rates come down, that should directly impact housing costs, because that's the biggest component of slowing down the housing market is raising interest rates. So if they can start to lower those, hopefully that can start to work on shelter costs and get them closer to that 2% that they're targeting. It's also interesting that auto insurance is so high. Has anyone else noticed higher auto insurance bills?
And what's driving that?
I was trying to look into it, but I think, of course, vehicle prices are higher than they were, so that's an impact. And I've heard that accidents are just higher because of distracted drivers. So I don't know if we all just got too engaged in our phone screen time over the pandemic that now we have bad.
It's probably due to our sheriff's department.
Well,
Sorry,
you have
Bob,
a
if you're
lot
watching.
more natural disasters now, too.
Oh, yeah. I think
So,
that definitely affects.
Between the wildfires and the
Yeah,
hurricanes and such.
that's true. Looking at labor, the next couple of slides, look at that a little bit. So a couple of positive things I would say. This job of openings and transitions report, if you look at where we're at now, it looks like, oh my gosh, it's just crashing down, right? This first chart on the left. But what's come out a lot lately are articles about how there's been all these shadow job postings that weren't even real, and a lot of companies had posted for jobs that they weren't even actively hiring on just to fill up their database, because jobs labor had gotten so tight. And so if you're a big company with labor needs, you kind of want to, what do humans do? If something's short, we try to hoard it. So they're trying to hoard contacts and get people in their system for when they do need somebody. But so even though there's been a huge drop-off in job openings, we're still at all-time high levels of job openings. So while the trend is drastic, it still leaves us at a really good place in terms of supply of jobs. And then the other two charts, you can see the top right, the amount of people willing to just quit their job has come down quite a bit. That's been trending down. But, that's also been contributing to inflation when people could just work a job, quit it, go get another job for more money. As a large employer here, I'm sure you felt the impact of that. So the reduction in quit rate is a good thing for employers. And it's still at again, pretty much all-time high level aside from the fluctuation. So it's not bad for employees either. It's still a pretty healthy spot, just a little closer to more normalized. And then the bottom one, layoffs, they're increasing, but again, they're still at all-time lows, right? So while all these things are trending back to normal and they're a big change from what we've had, by no means are any of them worrisome or when you hear a news report and they're like, all-time lows or, like all these words that are, extraordinary, it's really not. It's really just normalizing. And then looking at labor supply, so that comes from, young people entering the workforce, immigrants coming in. And then also a big impact is, or the job openings is all of the baby boomers still retiring and leaving the workforce. So we have to have these new folks coming in to refill it. And, again, we've had some off months where payrolls were a lot lower than expected, but all in all, they're still at a pretty healthy level. And labor force participation is really still at all-time highs. It's right around all-time highs. So we've got a lot of people working, and that's really good for the economy.
So, labor participation is higher than it was prior to the pandemic. Is that what I'm reading here?
Well, for immigrants, I think is the blue line.
Oh, okay.
Foreign born,
Oh, I see.
it's a little
Okay.
higher. For native born,
Oh, I
it's
see.
a little
Okay.
bit more normal. Yeah. Or no, the bottom one, Tom, sorry, that's age-based versus total. So it's higher for the 18 to 64, which to me is pretty much the working age. I think when you have total, you're just adding in like youth workers, basically.
I see. Okay.
Or people working longer into their 70s, but it's not considered the prime working age.
Okay.
So all of that is to say that consumer finances are still really good. Next
I'm sorry.
slide.
On that, can you also explain the chart above that?
Sorry. The top right is
Yes.
labor force growth. So blue is foreign-born workers and gray is native-born workers. So it's just showing you that the new workers coming in are about half and half. They're about half U.S.-born and half immigrants.
That's interesting. And explain 20, meaning, that means,
Sorry, what was the question?
explain 2020, so it is negative.
Oh, so that was the pandemic. Yeah.
Right, but so what?
So
So
the
that
labor
those
force
were laid
shrank.
off. Okay,
Yeah.
okay. Okay, thank you.
So next are consumer finances, and gosh, when you look at this, we're looking pretty good as an average consumer. So assets compared to liabilities, just looking at this, the height, of these two bars, relatively speaking. Obviously, not everybody feels that, but as an average, for the economy's sake, it's a really good place to be. That's also reflected in the top right, so that's debt service or, percentage of debt, based on income. And we're kind of right at that 10% level, which is way better than we were in '07. And then it's even really trend-wise below the average since 1980. So we're, not levered up. We're increasing our leverage, right, from where we were, which was almost zero during the pandemic. So it's a drastic change from a couple years ago, but it's still, relative to the past 30 or 40, it's still below average. So that's good. And then you look at bottom right, there's, sources of debt. So student loans are looking really good. Credit card and auto are kind of heading back up to more normal levels, but none of it is really super concerning.
But the student loan is misleading, isn't it?
I don't know. You could probably give a whole presentation on that. The professor from Purdue, Mumford, gave a talk hit on that a lot in January at the GLC's economic forecast lunch. I think some of the data he was looking at was saying that a lot of the folks whose loans were forgiven were folks with less amount of debt that had trouble paying it off. So if you think about it, this to me seems like all of that, delinquency dropped during the pandemic because nobody had to pay any payments. It was all paused. But now it's still super low, and maybe that's because a lot of people that genuinely couldn't afford their payments, those were forgiven, and the people that can afford it are making the payments. I don't know, but it's certainly not at all what we thought it was going to be, this crisis affecting the economy. Yeah, me neither. Next slide is federal finances, looking at that, and that's sort of a different beast. So where the consumer, we're kind of looking at a balance sheet, assets and liabilities. This is looking more like a cash flow. And clearly we're having to borrow a lot on the federal level just to make our expenses. The projections looking out ahead, if the Tax Cuts and Jobs Act is extended, that increases the deficit even more. But irregardless of that, we're on an uptrend, even from the ultra high levels that we're already at. So that puts us even above the ratio back at the end of the Depression. So none of that's good. All of that is to say taxes are probably going to have to be going up because we're not very good about cutting spending. So more importantly, the bottom left block is straight from the budget office's assumptions, so what they're basing things on. And if you look at that, GDP, they're expecting to trend back to normal by next year. The 10-year Treasury, so that's important to us, is trending back towards 3.5% to 4%, which is probably going to put the 5 years somewhere under that, which is what you guys are going to be able to buy. And then they're also projecting inflation to normalize back to that 2% range and unemployment to stay healthy. So this is sort of a textbook soft landing that everybody's hoping that we'll achieve. And it seems still, I think, really possible given where all the indicators are. The last few are more about the stock market, not exactly relevant to you guys, but I'll breeze through them real quick. The Michigan Consumer Sentiment Survey is usually a good indicator of kind of where we are with stock market inflections. And you can see the current level that we're at. Consumers are feeling worse in the very recent past about the economy, but overall, we're kind of at a lower range, which typically is good for the stock market because we're not overly exuberant like we tend to be at high points. The ink's not great, but you can kind of see the gray bars. Those are recessions. So you'll notice that we typically have a peak and a drop right as a recession hits. So starting on the lower side, we're less likely to be entering into one of those recessionary times. The next page also looks at recession bars in connection with elections. This is an election year, so we look at how that affects the economy. GDP has been on a steady growth. There's been a few, pauses here and there, but all in all, across a presidential term, it doesn't matter whether it's red or blue. The economy has still managed to grow pretty steadily either way. And then, again, kind of relatively looking at where we are, inflection points in the market. Most recently, we're on this sort of 54% increase, and you kind of look at these legs where we have a big expansion and then a contractionary period and then another expansion. Most of the most recent expansions, if you look back, have been 100%, 101, 400, 114. So at 54% in this phase, we're kind of on, halfway through like the typical expansionary phase in the market. So I think that's positive, despite valuations. And then lastly, one of the biggest kind of impacts on the market lately has been what have been dubbed the Magnificent Seven or the Mag 7. It used to be the FANG stocks, which was like 5 stocks, and then we've kind of expanded it with AI and the semiconductor expansion to the Magnificent Seven. Essentially, the Magnificent Seven has been all of the market movement for the past few years. Looking to the top right, it shows that the weight of the top 10 stocks in the S&P is 35%. Because it's a cap-weighted index where it goes by the size of the stocks. The high point back in 2000, so that was when we had the tech bubble burst, the top 10 then was only 25, 26% of the market, so we're 10% more than that in the top 10 stocks. That's a big deal. And then when you look at earnings, that's the bottom. So are these top 10 actually making the most money? And it turns out that no, they're not. They're making about 24% of the earnings. So there's a little bit of a dislocation there. So I think the good news is if you look at the next one, it's talking about how finally that is broadening out. So before, if you were in the S&P 500, but you weren't in a small portfolio of 7 stocks, you were falling behind. And that's not usually normal. So now you can see that it's broadening out, and you can see that in the top right. So the Mag 7 is in the green, and the S&P without those, just everything else is in the blue. And you can see how dislocated those were earlier this year. So 50% of the earnings growth was in the Mag 7, and the rest of the market was like losing money. And then it just kind of started to shrink down, and now it's more on par. So that is a trend that is kind of right-sizing now. Same with the share of return. So year-to-date, if you look at year-to-date, the percent of returns, the Mag 7 are up 29%, and the rest of the market is up 7%. And the share of return in the market is now more on par. So it's not equal to its cap weighting, but it's at least balancing out, broadening out. So we're seeing basically less of the weight coming from those handful of stocks in performance, but they still make up a huge part of the index. So, all of that is to say that in your portfolio, things are going to start normalizing, which means rates are going to start coming down. We should start to lose that inversion where the short rates are higher. That should start to normalize. And as far as continuing with rolling of the 5-year ladder, that still is a great strategy. And all the bonds that are coming due, as long as they're rolling out at that 5 years, they're capturing those 4% rates that looks like will be really good in a couple of years because we might not quite get that. I mean, it's hard to guess what's going to happen on a 5-year rate in 5 years, but 4% looks still really good. And that's all I had.
Thanks, Jessica.
Yeah.
Any discussion?
Yeah, basically, during budget time, and I guess if I didn't look at it, how much interest did you put in potential for next year for us?
Was it about $2 million that
I thought we, for the most part, entered the same as we did for '24. We expected it to decline in '24, and we did 90% of the '23 numbers.
Okay.
So hearing this, it might be a little bit high going into '25 if we do see those drops.
Mm-hmm.
And I don't think I heard you say who's going to win the election.
Correct.
Good answer.
Any other questions?
Thanks for having me. Always good to see everyone.
This
Appreciate it.
is always very well put together, so thank you.
Thanks, Jessica. Other business?
That from a banker.
I'd like to set the next meeting in advance because we have to approve the investment policy, which expires on January 16th of 2025. So I need to get it on the calendar before that date. The date that I was thinking is setting it after the county council meeting, but I don't know if you guys have other obligations.
On which county council meeting?
It would be January 14th, which is the second Tuesday of the month.
I thought you said it expired.
The 16th.
Oh, okay. Man, you're cutting it to the wire.
Yeah,
I usually have personnel committee after council.
okay.
Could we do it after our meeting on the 6th?
It's the end of the year, so it just takes a lot of time to get these statements in, especially with
Oh,
investments.
Yeah. Yeah.
It just takes a while to be able to, I don't think I would be able to meet that date of the first commissioner meeting.
What about the 13th? Like
Is that
the-
Monday?
Yeah,
It's good with my calendar.
like at 10 a.m. that day?
10 a.m., yeah.
I will be out of town. On the 13th,
Yeah,
Yeah,
that's
I'm
what the
going
suggestion was.
first half, I'm going the first half of that week.
Does it work for you?
Yeah.
Is it okay to have,
Or you could do the 14th, and Tracy said he's going to be going, so.
yeah, so January 13th at 10 a.m. is the, okay.
Can you verify the room's available? And will you, well, I don't know about streaming. Will you send an invite?
I will send an
Cool.
invite. Okay, so once Paula verifies the room's available, then the tentative date would be January 13th at 10 a.m. And motion to close, end the meeting?
So moved.
Second.
I think we need to have some discussion.